Good morning and welcome to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. Well, if you look at the global markets, the texture today not looking all that encouraging. But after that announcement of a 90-day reprieve on tariffs on all nations, barring China, we saw a very strong up move coming in on Wall Street on Wednesday. In fact, yesterday we saw the Asian markets reacting positively with GIFT Nifty, of course, clocking in a very strong rally. Last night, we saw the Wall Street sell-off once again with the Dow plunging over 1,000 points on growth concerns as a result of escalating tensions between US and China, which is why global markets are in the grip of sell-off this morning as well, this Friday morning. The GIFT Nifty is trading lower this morning, but we will be reacting to the two-day move. So yesterday the GIFT Nifty was up quite strongly. So today, right now, the implied open is suggesting that we will see a positive start. Of course, we'll have to wait for 9:15 to see how we really open up. But that's the overall texture of the global markets. Of course, the earnings season has also kicked off on a pretty grim note, so to say. The TCS has missed expectations. The management commentary, has taken into account the tariff impact as well. They've said that, but even though there are short-term uncertainties, they have maintained that FY26 or calendar year 2026 for that matter will 2025 for that matter will be better than FY24. So yes, we will be digesting those comments. We'll be taking you through the street verdict on TCS as well, and we'll also be taking up all your stock related queries. So keep them coming in. We will try and get them addressed by our experts on the show. But before we move any further, quickly take a look at the top headlines at this hour. Well, Donald Trump announces a 90-day pause on tariffs for all non-retaliating countries except China, for which the tariff rate jumps to 145%, taking into account the 20% levied weeks ago. China vows to fight to the end if a compromise cannot be reached. US futures extend losses following a weak session on Wall Street. All three indices give up almost half of their gains clocked on Wednesday. Dow plunged over 2.5%, while S&P 500 and Nasdaq ended lower by 3.4% and 4.3% respectively. The dollar index suffers biggest drop since 2022, and the yields, the US Treasury yields, are around that 4.3% mark. Asian markets resume sell-off on US-China trade war worries. Japanese market plunges over 5%. The GIFT Nifty, however, suggesting a higher start for our markets. We'll have to wait till 9:15 to see which way we head. Oil prices slipped nearly 3% on fears of a deepening US-China trade war and a possible recession. The US Energy Information Administration warns of lower oil demand growth from tariffs. Meanwhile, gold prices hit a record high of $3,171 amid safe haven demand. And TCS kickstarts the fourth quarter earnings season with a subdued performance. Company's net profit and revenue came in below expectations, while revenue in US dollar terms declined by 1% on a quarter-on-quarter basis. Deal wins, however, for the fourth quarter stood at record $12.2 billion. Meanwhile, management says FY26 should be better than FY25 despite short-term uncertainty. All right, let's quickly take a look at the cues for trade then. Wednesday, of course, we ended in the red, but still we managed to hold on to that 22,400 mark. We ended well off the session lows. The markets were volatile, tracking news flow around tariffs. IT, of course, was the biggest sectoral laggard ahead of TCS numbers. Pharma also extended losses as Trump reiterated the fact that he would be imposing tariff on pharma imports. TCS, Infosys, HDFC Bank and SBI were among the top laggards on Nifty on Wednesday. The market breadth was tilted in favor of losers with the NSE advanced decline ratio at 1:2. Gold financiers were in focus, ahead of RBI's, norms on gold loans. Muthoot, in fact, at one point was down somewhere around 12% or so, ended the day lower by 7%. Of course, the draft norms were released post-market hours. We'll take you through them, throughout the course of the show. City gas distribution companies were also under pressure, but volumes are pretty heavy there. Of course, the RBI also cut rates by 25 basis points, and they changed their stance to accommodative from neutral. Second straight rate cut coming in from RBI, banks, NBFCs, they were in focus. But for the month of April so far, let me just tell you that Nifty is down almost 5%, the mid cap index is down almost 4%, small cap index 5.5%. That's the overall texture. In comparison to global markets, we have still managed to fare pretty well. Because global markets have seen a sharp sell-off ever since the tariff announcement last, Thursday. We started reacting to that as well, but for us, the fall was a little more measured. But if you look at some of the sectors that took the worst hit, were the likes of metal, down 14% for the month of April so far, IT down 12% for the month of April so far. There could be some bit of short covering, when it comes to these sectors, owing to the 90-day reprieve on tariffs announced by Trump. But, without any delay, let me quickly bring on board our guest for today. Joining me is Raja Venkatraman, co-founder of NeoTrader. Raja, lovely to have you on the show. But tell us, given the fact that the GIFT Nifty itself is in the red, but taking into account the 2-day move, yesterday we saw a strong move on the back of the tariff reprieve. How do you think we are set to open? Do you think we'll see a positive open despite the fact that global markets are in the red? Because we haven't really, reacted to that 90-day reprieve yet.
Yeah, good morning, Nandita. Thank you for inviting me to the show. The way the markets are moving about, it's like a roller coaster, and we don't know exactly what is around the bend. So yes, if the markets were open, a big if, we would have been able to have a great start to the day. But then nevertheless, today also, yes, the GIFT Nifty is showing a negative compared to yesterday. But then overall, we are going to have a gap up. Now, for the gap up to sustain, there are some positive tailwinds from the macro emerging. The dollar is plunging, the USD/INR is stable, the oil is falling. So all those macros are helping. What is not helping is the adhocism of the Trump and its administration, and that is causing some fair bit of volatility right there. Now, how to handle this volatility? The best way is to look at stocks that have been moving, because indices, trading on the indices have definitely become a challenge, and neither the option data nor the chart setup are giving any kind of clarity at the moment. So the best scenario is look at some stock specific scenario where we have got some very good triggers emerging with the result season starting. So I would say that that would be a better area to focus right now rather than looking at the indices, because I think that it will take at least 1 week more, because the next week again we are having 2 trading holidays. So there is going to be a lot of uncertainty at the moment, and this uncertainty should be factored in while considering a trade decision, because markets are not very clear, and these right now what you are playing is the gap scenario. So the gaps are going to act as a very crucial support and resistance in the future. So I would say that on the upside, 23,200 would be a gap area. And on the downside, you'll have the support zones around 22,500. So we'll continue to play in this level for the next 1 week.
Okay, you reminded me that we have 2 trading holidays next week. That has cheered me up certainly. This patience.
Yeah, I would like to go in with a buy in Apollo Hospital, because I find that amongst the pharma names, this particular stock has been holding on to the current set of levels. I would buy it at current levels with a stop at 67.70 for a target towards 69.40, 69.80. And the other is from the cement space. I find that Ambuja Cement has come out of the recent set of cluster resistance. So I would say that it's a good buying possibility at current levels, and also on dip towards the region of around 840 for a target towards 865 and 870.
Okay, Apollo Hospitals and Ambuja, 2 recommendations, but hold that thought, Raja. Let's quickly get in a thought on how really TCS numbers have panned out. For that, I'm joined by Omkar Tanksale, who's the Senior Research Analyst IT at Axis Securities. Omkar, just about 2 minutes to go for the market open. I want to get in your initial thoughts on TCS numbers. They were fairly subdued. Margins came in below expectations as well, missed expectations by 30 basis points. We have seen brokerages cut target prices, but no downgrade as such. What are your own thoughts? How have you rated the stock after the numbers?
Definitely, I mean, it was a miss on all fronts, to be very honest with you, on in terms of revenue and in terms of in terms of margins as well. Despite ramp down in BSNL, there was a large contributor to the revenue, and it's a India business. So on overseas front, there might be there might be a gain in the margin side, but we believe that. Uh, uh, Going ahead, the uncertainty still is going to persist. As you know, the management has also commented over that the outlook is very skeptical. They are not seeing pickup in the discretionary spend, which is quite negative
Mm-hmm.
in terms of demand scenario. So we believe in
Sure.
terms of going ahead, there might be a uncertainty going around. So
Omkar,
I'm not very positive
Omkar,
about.
just 2 minutes. I'll be back to you. I'll come back to you for a couple of more questions, but I want to quickly take a look at the market open. The first ticks are showing a gap up start for our markets. 350-point gap up on the Nifty, and that's what the GIFT Nifty was also suggesting, a 400 to 450-point gap up at the start, and that's how we've started. Although the global texture is pretty weak, on the back of slowdown concerns amid escalating trade tensions between US and China, but we are reacting to that 90-day reprieve that was announced on Wednesday. So yes, let's take a look at the Sensex. 1,000-point up move here. 74,860 is where we are at. On the Nifty, 22,725. That's where we are at. The mid cap index in tandem with the benchmarks, 1.5% up move. The bank Nifty as well, is trading with gains of somewhere around 1% or so. I want to quickly see what IT, metals, and autos are doing, because these are some of the sectors that have gone that have gotten really beaten down after the tariff announcement. So quickly take a look at what the IT pack is really doing, because it will also be reacting to TCS numbers, right? So the Nifty IT up almost 2%. Muted numbers from, or subdued numbers from TCS, but it's a tariff reprieve rather, that's bringing some cheer. The metal pack is up 3%, pharma 3.5%. You also have the realty pack 1.5%. Yes, so all those sectors that were beaten down because of tariff have seen good up move today, led by pharma, metals, IT, and of course autos as well, almost 2% up. So all in all, a great start. But it, as Raja was mentioning, is going to be a roller coaster. We'll have to see whether we hold on to those gains or not, because global markets at the current juncture are not giving out a very positive signal. The US futures are trading with cuts of over 1%. We'll have to see how Europe also opens, this afternoon. So yes, that was all about how the sectoral picture is looking like and what the scene is like on the index front. But let's take a look at some of the movers then. I want to see what TCS is doing in trade. It's the top Nifty laggard, no points for guessing because of the management commentary on the future outlook. Although they have maintained that FY26 will be better, but there will be uncertainties with respect to what happens on the tariff front as well. Only two laggards, TCS and IndusInd Bank. All the other rest 48 names on the Nifty 50 are trading with strong gains. Sun Pharma, Cipla, pharma names dominating the gainers list. Sun Pharma, Cipla up 4% each. Tata Motors up almost 4%. Tata Steel up 3%, Hindalco up 3%, Coal India, JSW Steel, all of these counters are up in excess of 2%. So yes, a very strong start, almost a 400-point up move as we speak, very close to 22,800. Let's see whether these initial gains sustain or not. The advance decline ratio extremely strong, 2,000 gainers to 120 declines. So 16 or 17 is to 1. That's the NSE advance decline ratio at the current juncture. Things are looking extremely good right now. It's seeming to be a fantastic Friday. As of now, but let's see whether this momentum continues or not. But Omkar, we were talking about TCS numbers and the future outlook. They have said that there were no large deal cancellations, but there are ramp downs and delays in decision making as well. But still, they have
Yes.
maintained FY26 will be better than FY25. Would you be that optimistic?
Yeah, I mean, definitely over the longer term, your dependency, I mean, the large enterprise dependency on the systems and the technology has been grown significantly in past few years. And, demand for the new age technologies like cloud transformation, generative AI business is continuously increasing. As you know, these uncertainties getting settled down, we believe that the discretionary spends will likely to come back, but we do not know how much time it will take. Definitely, I mean, after maybe the second half of FY 626 will be a much better scenario, and we may see a pickup in the demand scenario going ahead.
Okay, so what's your call on the stock now? Would you maintain your ratings, and in terms of target price, have you made any changes?
No, I haven't made because we everybody knows. I mean, the on the demand side there is a
Pardon?
not
Hello?
lot of pickup. So we are maintaining a hold on the decision currently, and we are not very optimistic about the IT for at least for the couple of quarters.
Okay, point taken. But I know, what are your expectations from other IT players like Infosys then? Is there any chance that these companies may cut their guidance or refrain from giving any guidance in the wake of tariff uncertainty?
Yeah, I mean, definitely there is a possibility that they may reduce or they refrain from giving the exact guidance. But we believe that after the one quarters, I mean the one Q FY 26, there might be a better visibility going ahead because there is a lot of uncertainties going around. So once that gets settled, because I is a one sector that it's not a, one quarter or 1 year scenario. They generally have the multi-year contracts and sticking to those contracts. So business consistency and continuity is still there. So there might be a not lot of impact on the current revenue budget or current revenue size that they have, but definitely there might be curtail and uncertainty in the growth momentum going around that might hit ups and downs. But I believe in 3 to 6 months we'll get better visibility going ahead.
Okay, in the next 3 to 6 months, we'll get better visibility. But what about mid-cap IT? How are you looking at some of these outperformers like Persistent, Coforge? We had a report from a global brokerage, on Wednesday, wherein they had cut target prices quite sharply. Your thoughts on mid-cap IT now? Would you also, cut your targets, or what is the, picture like when it comes to mid-cap names?
Yeah, I mean, definitely the mid cap is also not going to perform better, but definitely it's going to surpass the growth as compared to the large cap because deal size has been shrunk and the trends are changing. So these players are targeting on a smaller deal size and more on of agile part as compared to these large caps. So they likely to perform better, but the valuation comfort is not there. They are extremely high pricing as compared to the large caps. We might see not that much gain in the mid caps as have seen after the COVID, like Persistent, KPIT, Coforge, and such kind of a company. But definitely, I mean, they are likely to surpass the growth and likely to perform a better margin portfolio because they are into the transitional phase, and that too year-end for this quarter is also likely to perform good apart from KPIT and the Cyient.
Okay, that's the view then. With that, Omkar, would like to thank you for taking out time and joining in this morning and sharing your thoughts with us. As more and more IT names come out with their numbers, we will again touch base with you and get you on the show to understand your views.
Definitely. Thank you.
Thanks a lot. On that note, of course, let's quickly take a look at what the street is saying about TCS after numbers. Nomura has a neutral rating here. A target price has been cut to a shade below 3,500 rupees. It has pointed out that there are more misses than hits in the fourth quarter. Growth visibility for FY26 remains unclear as of now, and they've cut their FY26, FY27 EPS estimates by 2 to 3%. Stock, meanwhile, according to them, is trading at 21.4 times its FY27 EPS. Goldman Sachs also, it has retained its buy call. Target price has been cut to 3,960 rupees. They have noted that the fourth quarter revenue growth, EBIT margin, these were all below expectations. And of course, they have reduced their FY26, FY27 revenue estimates by up to 3%. Jefferies, hold rating here, target price cut to 3,400 rupees per share. And margin miss, according to them, is the key negative surprise, and they have cut their FY26, FY27 EPS estimates by 3.5%, and they are expecting 8% EPS compounded annual growth rate over FY26 to FY28. Coming to you, Raja, you've been waiting patiently, but what would you do with IT names, especially today when we have seen a good bounce, and in particular TCS, today of course it is reacting to its numbers. Down somewhere around 2/10 or 3/10%. So overall, IT, would you get out of IT on this up move, or would you add more? I mean, how would you approach?
So currently in the entire IT space, we just started with the result season. Well, TCS has not given a great start to the IT results that are going to unfold. But what I would do is I would wait for the entire major IT results to come out before I take a view on the IT earnings combined with the Trump effect. So we need to see everything in the context. So now the context has changed a little bit, and we need to address how the Trump tariffs, etc., are going to settle down, because right now there is a lot of dust which is there around the tariffs, and that unless we achieve some clarity and combine it with the results flow which are going to come out, I think that we should wait patiently before doing anything in IT, because right now there is fair bit of uncertainty.
Okay, there is fair bit of uncertainty when it comes to IT. But another pocket that has been in focus since Wednesday, I beg your pardon, is gold loan companies like Muthoot. It took a sharp knock after RBI, hinted that perhaps it would tighten gold loan norms, and we saw 12% downtake, but then it staged some bit of recovery, ended 6% lower, but then there were some draft norms released in terms of gold loans post market hours, and today as well the stock is down 5.5% or so. Now RBI has unveiled a new set of stricter regulations for financial institutions that give gold loans, which are basically loans secured by gold. The move RBI has proposed is aimed at refining the underwriting processes, enhancing the management of collateral, and ensuring that the funds are utilized appropriately. So the RBI has suggested a comprehensive array of guidelines. Now these include the establishment of specific limits for single borrowers as well as sectoral caps on the gold loan portfolios of banks. Additionally, mechanisms to verify the end use of loan funds, a mandated loan to value ratio of 75%, and standards pertaining to the purity of golds have been proposed. Of course, reading through all these guidelines, the proposed guidelines, some of the brokerages have come up with notes, and they have said that growth will be impacted. But particularly for a Muthoot Finance that has a higher share of gold loan, would you or how would you look at this stock? Would you say that there's been a fresh breakdown on the charts? Should one get out of this stock, or should one add more? How would you look at it?
So considering the way the regulations have come out and the reactions which we are seeing right now on the gold loan, it is clear that there has been some disappointment in the way the overall guidelines is being looked at. So these guidelines are taken as a negative impact, and I feel that since the move has been quite steady over all the uncertainty and volatility over the last 6 months, I feel that it's a time to at least partially book out and look for lower levels to buy into. The picture is not yet disturbed. Even on higher time frames, the chart continues to hold on, and this kind of news flows are bound to bring in some kind of reaction on the downside if it has gone up. So now lower levels can be bought into, but then yes, if you have been holding for a while, you can book some profits here and look for lower levels closer to the region of around 1700 to buy into.
Okay, that's the view on Muthoot. In fact, we had a query on this stock from Naveen. Naveen, we have addressed this query for you then. Hope this helps you. But let's take up another query then coming in from Rupak Mehta. This one is on Zomato, or Eternal, so to say. Wants to know what is the relatively good price to enter Zomato. This is of course one stock that we end up discussing almost every week, Raja. But given the fact that the stock has done fairly well in the wake of the weakness in the market over the last 5-6 sessions, at 214, does it merit a buy? Because it's quite, it's quite a bit away from its 52-week highs of 305 or thereabouts. Would you advise looking at a Zomato?
Yeah, the stock has managed to hold on quite well over the last few weeks when there was, a lot of volatile scenario. Plus, there was a lot of selling pressure as well. Now, after its, inclusion into Nifty, we can see that the overall trajectory in the last few days has been quite encouraging, and the FMCG plus QSR space is showing some traction here. So this would be a good point to enter. Now, if you enter here, your aggressive stop loss would be below 200. You can expect an upside towards 280 to 320 within the next 6 months.
Okay, 320 levels can't be ruled out on the charts of Zomato within the next 6 months or so. What would you do with metal names now, Raja? I mean, metals have also seen a fair bit of sell-off, and now with the tariff tensions escalating between US and China, metals could be volatile going forward. So Yogesh wants to know your view on the entire sector as to how you should navigate. The likes of Tata Steel, etc., are staging a good comeback today. Do you think it's a good opportunity to get out?
No, the kind of scenarios which you see in metal is closely linked to China because they are the largest consumers of metal. Despite the downturn in the economy, they will still consume fair bit of the metal space. So that is why you are seeing that anything whenever China comes into play, the metal sector gets impacted. Now, the metal sector, be it a Tata Steel or Jindal Steel or JSW Steel, they have all been doing fairly well over the last 2 months. And what I would say is that any reaction or any dips that come into these counters could be a good area to consider from a short-term investment perspective. So I would not say it's the time to get out. Any dips in these stocks should be considered as a buying opportunity because overall prospects continue to remain positive, and also with the domestic end as well, with the government supporting the growth, etc., and the industrial production, I think that the steel sector will continue to do well.
Okay, that's a view on the overall metal space. Hope that answers your query. I think it was Yogesh who had sent in that query. But we have a query coming in from Shweta Naidu, and she has a query on some of these defense names like GRSC. She holds GRSC in fact at 2,217 rupees. She wants to know if it's a good time to hold and recover, whatever capital was lost, or exit and buy Zentech at current levels. What would you advise? Because all these defense names have seen renewed buying interest. If you look at the last 1 month or 1.5 months or so, would you recommend holding on and waiting for her to recover her losses, or how would you approach? Should she switch to Zen?
I would say that one should continue to hold on to GRSC. Yes, the defense names are once again attracting some attention after a while. And GRSC has been on a steady run, and the recent profit booking, if I were to say, has found some feet, and we are again having a resumption in the bullish bias. So this would be a good time to add, and from the pricing at what she has purchased, this would be a good time to do some averaging and have a stop loss below 1400 and continue to hold on to this stock, because once again, there are possibilities of flashing a new high by the end of this year.
Okay, by the end of the year, you can expect new highs on some of these defense names as well. One query coming in from Debu K wants to know your thoughts on G Power India and Bundada Engineering for investment at this juncture. G Power, if you see last, in fact, year to date, it has shaved off 39-40% or so, and it has been stuck in a downtrend, so to say. Any thoughts on whether one should buy into it now? Today, of course, in tandem with the rest of the market, it's up 4%. But these two stocks, your thoughts on how it's looking right now?
Yeah, so G Power is not so much of a mover. So when you are holding stocks like G Power, one should consider the time frame of your investment, because overall, from a higher level perspective, the prospects of G Power going towards 400 is very much on the cards. But then the question is whether are you willing to wait for the next 1 year? Now the problem is that everyone is interested to purchase a counter, but they want immediate return. But then the stock doesn't move in that fashion. So a stock like G Power will definitely require you to be a little patient. And at the moment, the stock setup is a slow mover, so it would take some time. I would say a move below 205 would clearly spell some downside for this counter. So below 205, one should look to exit. Otherwise, the stock has got good prospects of moving towards 400.
Okay, that's a view. Hope that answers your query. But before I end the query segment and our chat on the charts, I want to get in your thoughts on an SRF. This stock has done extremely well on a year-to-date basis. Today as well, it's up 4% or so. The company has commissioned and capitalized new agrochemical facility in Dahej, in Gujarat, at an investment of 239 crore rupees or thereabouts. Given the fact that this stock has seen a very good run, on a year-to-date basis, 2,834 is where it's at. Would you, expect the stock to retest levels of 3,000 anytime soon, given the kind of momentum it has seen?
Yeah, if you consider the specialty chemical space, SRF has managed to hold on to the upper ends of its move quite well in the last 3 months. Now, with the result season coming up and also with some encouraging news flows, I think that this consolidation is now going to give away, and it's going to give away on the upside. So this is a good time to consider this stock on a trading front or also on a short-term investing front, because I see that the stock has got potential to move to the region of around 3,500 to 3,700 within the next 3 months. So it's a good setup to consider.
Okay, good setup to consider SRF within the specialty chemical basket. But with that, we have come to the end of the query segment, and Raja, would like to thank you as always for joining us on Fridays and sharing your thoughts with us. Look forward to touching base with you next Friday as well.
Yeah, thank you so much. Bye. Good day.
Thank you. Well, on that note, look at the market, almost 400, in fact 420 points up as we speak. We have clocked in that 22,800 mark once again. Although the global markets are trading in the negative zone, we are reacting to that 90-day reprieve that was announced by Trump on Wednesday. But of course, let's quickly get in, our big market voice then on the show. Joining me is Ajay Bagga, market expert. Ajay, lovely to have you on the show, and that too on a Friday. We are looking at an extended weekend, a truncated week next week, and we've in fact set the stage for this rally to extend, or do you think it's just a one-day wonder? What are your thoughts?
Very difficult to say. I think we have seen today's gap up, and there is some follow through buying. But you could see selling coming in because Monday is a holiday again in India, and people will not like to carry through today's positions over this long weekend. So overall, where are we right now? I think the situation has improved with the postponement of reciprocal tariffs on 58 plus countries, and US is talking about bilateral deals with over 75 countries that have called in the US Commerce Department. So let's wait and watch what comes out of there. What is roiling the markets right now are the 145% tariffs on China. If you look at the US, import of goods breakup, China with about $500 billion of goods being imported into the US. 145% on that is massive. So that takes up the entire US tariffs to about 25% on a weighted average basis, which is the highest since 1909. So it's a 100-year high. It will lead to inflation. Goods will not be supplied at 145% higher tariffs. So there are anecdotal news reports of Chinese factories shutting production temporarily. ship hiring for the Trans-Pacific logistics journey. There's a lot of cancellations of container ships. So overall, I think it will bring down the commerce between US and China. There have been reports of some of the US heavy manufacturing companies protesting that if say the same goods from Korea or Vietnam or Malaysia are given 10% tariffs and their steel aluminum is coming in at 25%, that puts them on a wrong footing. And that's what actually happened in 2018 when steel tariffs were put in. 1,000 jobs came up in US steel, but 75,000 jobs were lost in end users of steel. So all the forging companies, all the machine lathe companies, all that make equipment out of steel, they saw 75,000 jobs going. So it's a very difficult situation. The risk has reduced on the margin, but we saw the relief rally on Wednesday not having legs in the US. So in that kind of a scenario, difficult to foresee India going up much more than today's bounce. Today's bounce is the Wednesday US bounce that's coming in.
Sure, and of course we fell. We didn't fall as much as global peers. So, are you saying the upside for us will be far more limited? When you compare us with global peers like Japanese markets, for instance, or even Hang Seng for that matter.
Yeah, today, over yesterday and today, they have given up nearly a third of the Wednesday impact. So I don't see what is the trigger for India to rally. One trigger, if everything else was the same, if Trump tariffs were not there, three very big positives were there in the market. First, the US index at 100, as it breaks the 100 level, classically emerging market flows used to increase. But right now, given the risk of sentiments, people are not buying US treasuries. Every amount of funds are going either into Swiss franc or yen or into gold. Even US treasuries, nearly $50 billion of sovereigns were sold. So the news is it's not China, it's Japan, which is increasing its cash holding. But where will money come into emerging market equities in a risk off like this? Second, the inflation going down in US should have been a big boost to global markets, that Fed will be able to cut rates faster. The PCE number from March should come very near to 2%. But again, we didn't see any relief coming on that. Third, the US hard data is still good.
Sure. I also want to ask you what happens to autos and metals, because 25% tariff stays, right? So in that sense, would you still or would you use today's bounce to in fact get out of these sectors?
Yeah, you hit it on the nail. I would say it's a sell on buy, sell on rise. So reduce your positions. What is under threat? I think IT, pharma, he has said that sectoral tariffs are coming now, whether saner voices, are able to stop that. Yesterday, if you see the negotiations in the US Congress, within the Republican conference, they passed the Trump budget agenda, and 20 conservatives were holding out. They said, we want to see a spending cut, and we want you to guarantee that there will be no cuts to Medicare. So both, then Trump has made the calls to those 20 holdout Republicans and said, yes, we will cut spending by $1.5 trillion over the next 10 years, which, it's not worth the paper written on, but at least it's a thing. But the big thing was on Medicare, he said, we'll not cut. So if they are not going to cut Medicare and they increase pharma, it does not make sense. So, Nandita, it's these inconsistencies of policy, because if you look at the whole picture, you want to make America great again, but you put tariffs on steel and aluminum, which you don't produce in large. US is now making 4 million tons. India has plants which are making 4 million tons. China makes 1 billion ton. China has 50% of steel output. okay, it's a good thing to put 25% on steel, but first make your factories and then put 25%. Today, you can't produce that steel. You're not going to make 100 million tons of steel even for the next 3 years. Where will you get that steel? So your factory cannot come up because you're making it so expensive, but you are shutting down trade. So these are the inconsistencies by which the market is just sitting and watching that what do we do? And business sentiment is bad, consumer sentiment is bad, investor sentiment. So I would totally agree with you. If you get a chance to get out of Indian auto and Indian metals, sell and get out of it.
Okay, that's some viewer queries that had come in, and I want to take it up. Because the big question right now is whether to sit on cash, deploy cash. How one should really be navigating this leg of the sell-off. Although long term, when you talk to market experts, they say that the fundamentals are in place, but the tariff-driven uncertainty, it is expected to persist, right, in the coming months. So I just want to take up this query from Advait Joshi, who's saying that with so much volatility in the market, would you advise sitting on cash or buying on dips from a long-term perspective? And if it's the latter, which are the sectors that need to be focused on heavily that have already corrected or seen a heavy correction, in the wake of the tariff turmoil? Also, the fact that a lot of investors tend to stop their SIPs when markets really go haywire or tend to sell off quite significantly. Would you, in fact, go ahead and say that it's time to actually ramp up your SIP investments?
No, no ramping up, but don't stop either. So this could be drawn out. We have no guarantee. We have seen 5-year, 7-year periods in the markets when you didn't get returns. So this time the disruption is really huge, and we really don't know the US playbook because it's not consistent. If you knew a policy, you could plan for it. If the policy changes every 4 hours, it's very difficult. Second, the checks and balances have gone out of the US. So it's become an imperial presidency where 3, 4, 5 advisors are really deciding what has to be done. In that sense, when checks and balances from the Congress go away, then policy uncertainty really increases. So we really don't know what the situation will be 3 months from now. As you said, that 10% tariff, will it stay at 10 or on a whim and fancy because Xi Jinping is going to Malaysia, to Vietnam, to Asian countries next week. Again, it will be announced that anyone who talks to China will be hit with more tariffs. You can do anything in this kind of a scenario. It's not a Congress which is deciding. Article 1 of US Constitution says trade is the Congress purview. They are the ones who increase taxes or increase tariffs. But there are emergency powers which Nixon had invoked in 1970s. So under that act, Trump has taken over that tariff power. Now, Congress, will it take back? All the parliamentarians are beholden to Trump. As we saw yesterday, his budget largely the Republican caucus has passed it, and it will now come for voting in the House. That should have been a big surge for the markets because there you're making the tax cuts another 5 years, you're extending them, you're deregulating very heavily, you're bringing in some subsidies for key industries. So it should have unleashed the animal spirits. But by going first after trade, the sentiment is spoiled. If you look at 2016, first he did all his reforms, and then 2018 he went after China, and that also in a calibrated manner, 10%, then 21%, and he ended at that. Biden came and increased it quietly, but none of us even noticed. 4-5% were increased even in Biden administration, and they did those technology sanctions on Chinese companies. But this time around, it has been like the Wild West. And that has really, if a bond market gets unhinged, that shows you how big the risk of sentiment is. If people are selling US treasuries, which is a safe haven, normally you say $29 trillion market money is very safe, but the sovereigns don't feel safe after the Russian money was seized in 2022. So China has been bringing down its holdings, but it is too big for it to sell. $800 billion it can't sell. That market will collapse. So slowly, probably they are selling. Yeah.
Right. I have a whole lot of more questions, Ajay, but
I'll
due to
go
paucity
fast.
of
I'll
time,
go
I can't
fast.
ask you.
Yeah.
No, no, no. I will ask
Yeah.
you one last question then, in that sense. What do you make of the draft RBI guidelines on gold loans? We've seen sharp reactions on shares of Muthoot as well. Of course, this is one segment that has seen, stupendous growth over the last 2, 3 years. Was this move warranted? How does it really impact the trajectory going forward for these companies? What have you made of these guidelines, which are still, a proposal as of now? But your thoughts on the guidelines that the RBI has come out with?
No, guidelines are good, especially the LTV 75%. It will take some risk out of the market. And also, it is putting on par the NBFCs and the banks in terms of treatment of these loans and the policies. So, we must not be afraid of this kind of regulation, which brings a very level playing field and it brings clarity. Now, based on this, people can build plans to grow their business even further. Gold loans are really surging, and it's a beautiful product if you are running it well. The risks are the holding of the gold, local level fraud, where you take out employee fraud insurance, you take out robbery insurance. And the third risk is if you lend too much to people who are not able to repay. So it should not become a collateral based. That's what RBI is saying. End use and this, that, not very possible. You will take a declaration, but for a 5 lakh, 10 lakh loan, you will not be able to monitor end use and stuff like that. So I would say look beyond. And it's a huge market, 25,000 tons of gold sitting in Indian households. It allows households to borrow even without a credit history because the collateral is so good. And at 75%, it's limiting the risk. So after three installment skips, you can literally just seize the gold, sell it off, and make your loan book whole. So it's a great product. It's good that regulations are coming in. We should see it like that. Any change, of course, makes the markets uncertain, and I think it's inordinate the way the gold loan companies are being sold. There's no such bogeyman sitting in those regulations. It's rather creating a good, transparent, level playing field with proper accounting and proper end use monitoring. I don't see a big issue with those regulations. They are good. They will make the industry guardrails stronger and lead to a better outcome over time. So that way, good time to buy these NBFCs and banks which are big in the gold loan scheme.
Point taken, Ajay. And lastly, very quickly, what should the portfolio construct look like now in times of such volatility and uncertainty when it comes to the global tariff scenario?
I think what will the focus should be on the domestic sectors. Again, this could change in 6 to 12 months. So that's why I'm wary about giving these outlines. But I think banks, you will not get great results this time around. So wait for that to come through, and then you can buy more banks, financials. Overall, the entire financial gamut is good. Domestically, I think power, infrastructure, all these should do well. And metals we have to stay away from. Metals, the problem is in China. And if this US trade war continues, Chinese factories stop using so much metal. And China clearly, for the last 3, 4 years, the 2008 playbook is not being used, where they built out huge infrastructure to spend their way out of trouble. They're neither spending on the consumption basket nor are they spending on infrastructure. So they're conserving capital. In this uncertainty, if China doesn't spend, metals are headed downwards. So metals, I would say, stay away. That's more global scenario, but all domestic sectors apart from auto, but consumption, consumer durables, banks, finance, I think all these should do well.
All right, point taken, Ajay. Very comprehensive answer, and always helping us out and our viewers out as well when it comes to how to navigate the market in whatever state we are in. But with that, would like to thank you for taking out time and joining in. Would like to wish you a very happy extended weekend. It's a truncated week, a 3-day week next week. But yes, we are also getting into the earning season. As more and more companies report numbers, we'll take stock of that as well, and we'll touch base with you for more interviews going forward. Thank you, Ajay, for joining in.
Thanks very much. And your job has become very difficult because every 2 hours Trump changes policies and then you have earnings season. So there is so much, and you prepare one day, 1 hour, and by the next hour it's irrelevant. So all the best to you and your team to cover these markets.
Thank you, Ajay. Hazards of this profession, but yes, it's exciting nevertheless. Thank you, thanks a lot.
Thank you.
Well, with that, take a look at the market. It's a good, thank you. It's a good 2% up move, almost a 450-point up move on the index, 22,850 on your screens. The mid-cap index also holding out pretty strong. The breadth is firmly in our favor, and the bank Nifty is also 1.5% up. Metals, IT, all these sectors are trading with strong gains. But let's see whether or not the momentum continues as we progress through the day. But with that, completely timed out on this edition of Opening Bell. Thanks a lot for tuning in. Stay tuned to Money Control for all your news and updates, and have a great trading day. Thank you for watching.